Good morning, hunters, and welcome back to the Daily Hunt for Multi-Baggers on this Friday, June 12, 2026. What a week it's been, and yesterday's data, Brooke, well, it's certainly delivered.
You got that right, Ethan. Our AI systems crunched a significant volume of social media discussions from Thursday, June 11th. We saw a lot of chatter, flagging quite a diverse range of stocks. The overall market sentiment feels pretty mixed right now, a good blend of high growth optimism and some very cautious risk assessment.
All right, let's jump right into it. First up, we've got Adobe Inc., ADBE. The buzz around Adobe's Q2 earnings was massive, and the company delivered, beating revenue and EPS estimates. Users are talking about Adobe having its AI behind a paywall and already calling it dinner. That's a strong growth narrative right there, especially with impressive metrics like a PEG ratio of 0.62 and insider buying of over 120,000 shares recently. It's trading at its 52-week low, which, could be a classic undervaluation play for a company with such strong fundamentals. It was previously rated as stay away multiple times, but I think the underlying value makes it a potential turnaround story.
Hold on, Ethan. While those KPIs like the low PEG and insider buying are interesting, we can't ignore the elephant in the room. The stock dropped significantly right after those strong Q2 earnings, hitting its 52-week low. That's a huge red flag. Users are expressing deep dissatisfaction, talking about AI eroding Adobe's competitive moat, and even questioning leadership with the recent CFO departure. A great PEG ratio doesn't matter if the market is fundamentally reevaluating the company's long-term competitive position. This isn't just short-term noise, it's a structural concern. My analysis would be to approach with extreme caution.
Fair points, Brooke, but sometimes the best opportunities are found when everyone else is, panicking. For Adobe, ADBE, given the strong underlying metrics and insider confidence at a 52-week low, I'd say this is a cautious buy.
Next, let's talk about Nebius Group NV, NBIS. The sentiment is wildly bullish because of its upcoming inclusion in the NASDAQ 100. People are talking about NBIS gonna fly and seeing huge price surges overnight. They've also seen significant growth over the past year.
Yeah, Brooke, the NASDAQ 100 inclusion is a massive catalyst. It brings increased visibility, liquidity, and mandatory institutional buying. This is exactly the kind of event that can drive a stock, regardless of some of the past performance. We've seen NBIS rated as a speculative gamble or stay away many times before, but this is a game changer for market perception.
But Ethan, the fundamentals screen caution. NBIS has an extremely high debt-to-equity ratio of over 132. Their net profit margin is a meager 0.9%, and their operating margin is actually negative. This company struggles to generate profit, and insiders have been net sellers, offloading over 2% of their holdings. A low PEG ratio is meaningless if the company isn't truly profitable. The NASDAQ 100 inclusion is a perception booster, not a profit generator. For Nebius Group NBIS, my verdict is stay away.
All right, moving to a tech giant, Alphabet Inc., GOOG. There's a cautiously bullish sentiment, largely driven by its significant stake in SpaceX. Users are predicting big things, talking about it being 15% off ATHs and no end of their empire in sight. Plus, we saw solid insider buying, over 4 million shares, and a 21.8% revenue growth. GOOG has a history of being a buy on this podcast, and those fundamentals are rock solid.
While Alphabet's strategic investments in AI and Waymo are commendable, and the insider buying is a good sign, the PE ratio of 27 isn't screaming undervalued based on current earnings. Users also express concerns about AI spending and monetization. A big SpaceX pump might be speculative, and some users even warned about a potential dump if SpaceX hits turbulence. We've had mixed ratings for GOOG recently, including stay away.
But the underlying business, Brooke, is an empire, and that SpaceX exposure is pure upside. For Alphabet, GOOG, I'm confident to say buy. Let's look at Rocket Lab Corporation, RKLB. This one's also riding the NASDAQ 100 inclusion wave, and the sentiment is incredibly bullish. Users are saying, let's go Rocket Lab, and one even bought $250K in calls. The stock has seen substantial growth over the past year, from $26 to over $114. Plus, insiders have been net purchasers of over 30% of their holdings in the last 6 months. That's a huge vote of confidence. This stock has often been a speculative gamble or stay away, but that insider buying coupled with the index inclusion is powerful.
Ethan, the enthusiasm is undeniable, but the numbers show a significant risk. RKLB is currently unprofitable, with a negative net profit margin and EPS. Its price-to-book ratio is incredibly high at 29, suggesting extreme overvaluation based on its assets. And while they have revenue growth, the debt-to-equity ratio is 6.12. The NASDAQ 100 inclusion will boost visibility, yes, but it doesn't solve the core profitability issues. We've classified RKLB as stay away many times, and despite the positive news, those fundamental challenges persist.
It's a growth story in a high-potential sector, Brooke, and the insiders are clearly putting their money where their mouths are. For Rocket Lab RKLB, this is a cautious buy.
Now, for another NASDAQ 100 edition, Astera Labs Inc., ALAB. The sentiment is bullish, fueled by the index inclusion and strong analyst endorsements. RBC just set the highest price target, and users are sensing FOMO. It's trading very close to its 52-week high. Historically, it's been a speculative gamble. Ethan, this is a high-growth stock priced for perfection and then some. ALAB has an astronomical PE ratio of nearly 250 and a PB ratio of over 42. Its beta is almost 4, meaning it's highly volatile. To add to that, insiders have been net sellers of over 2 million shares in the last 6 months. They're cashing out. While the NASDAQ 100 inclusion is a positive event, it doesn't justify these valuations or the insider selling. For Astera Labs ALAB, my analysis is stay away. The risks are just too high.
Up next, we have CoreWeave Inc., CRWV, also entering the NASDAQ 100. Users are extremely excited, predicting calls will take so much Cialis and expecting a major surge. This company is expanding rapidly in AI data centers, which is a fantastic growth area. It's been stay away or speculative gamble previously, but that NASDAQ 100 news is big.
Big news doesn't fix a broken balance sheet, Ethan. CRWV has an eye-watering debt-to-equity ratio of over 738. It's deeply unprofitable, with a negative net profit margin and EPS. And guess what? Insiders have been dumping shares, with net sales representing nearly 23% of their total holdings. They're tapping the junk bond market to fuel expansion, which only compounds the debt risk. This is a highly leveraged, unprofitable company. For CoreWeave CRWV, it's a definite stay away.
Shifting gears to Broadcom Inc., AVGO. Sentiment is strongly bullish, with users going all in on AVGO and calling it a top AI stock. They feel it was battered for no reason and is trading at a discount. With nearly 48% revenue growth and stellar net and operating margins, plus a PEG ratio of 0.7 suggesting undervaluation, this looks like a strong player in the AI space. It's seen some stay-away ratings, but mostly cautious buy and buy.
Ethan, while the revenue growth and margins are impressive, a PE ratio of 64 is still very high, indicating significant growth expectations are already baked in. There's also been some recent insider selling, albeit minor, and we have seen the stock bounce around, with stay away as a previous rating. It's a high-growth story, but we need to manage expectations for a company trading at those multiples.
I see strong conviction, strong growth, and what I believe is an unjustified dip. For Broadcom, I'm calling a buy. Now let's talk about Berto Acquisition Corp. This one saw a user make a whopping $36,000 profit on 0 DTE calls in just over an hour. That kind of rapid gain generates incredible community optimism and makes people wonder about its potential.
Ethan, that sounds less like an investment opportunity and more like a casino story. The analysis clearly states this was driven by speculation or luck, possibly external factors, and certainly not fundamental strength. Taco has 0 net profit margin and 0 operating margin. How do you justify a PE of almost 30 with no profitability? Its historical stock performance shows it's traded in a narrow range. There's no fundamental discussion, just a gambling narrative. We've consistently rated Taco as stay away.
Well, sometimes you just have to ride the wave. But I hear you, Brooke. For Berto Acquisition Corp., TACO, the verdict is stay away. Next, we've got Microsoft Corporation, MSFT. Users are frustrated, calling it a bag holding situation and saying it always dumps after earnings. It's down significantly from its 52-week high, which, fuels that sentiment. Microsoft has seen its share of stay away recently.
And the user sentiment is overwhelmingly bearish, Ethan. They're explicitly critiquing its sideways trading and consistent underperformance. However, fundamentally, MSFT is a juggernaut. It boasts a nearly 40% net profit margin, 18.3% revenue growth, and an incredible 34% return on equity. This company is highly profitable and financially stable with low debt. While the stock has dipped and there's insider selling, those core financial KPIs are incredibly strong. It's often rated buy for good reason.
You're right, Brooke. Those fundamentals are hard to argue with. Despite the short-term grumbling, this is a solid company. For Microsoft, my verdict is a cautious buy for the long-term investor. Finally, let's wrap up with Meta Platforms, Inc., Meta. The sentiment is cautiously optimistic, driven by confirmed acceleration in AI capital expenditure. Analysts are recognizing it as a top AI stock and a best forever stock. Plus, its PE ratio of 0.83 suggests it might be undervalued. Meta has consistently been a buy on our show for a long time.
Ethan, while Meta's AI investments are exciting, the stock is near its 52-week low, reflecting investor debate about the high costs and uncertain immediate returns of those AI initiatives. Regulatory risks, like a potential youth ban in Canada, are also on the horizon, and we've seen Meta swing between buy and stay away in recent months. Its strong revenue growth and profit margins are great, but the current price slump and market skepticism are real.
I think the market is overly skeptical on this one. Meta's commitment to AI and its strong profitability are huge. For Meta Platforms, it's a clear buy.
All right, Ethan, let's compile our final list of candidates for deeper analysis after today's exciting discussions. Investigate as buy, Meta Platforms Inc., Meta, Broadcom Inc., AVGO, Alphabet Inc., Google. Investigate as cautious buy, Adobe Inc., ADBE, Microsoft Corporation, MSFT, Rocket Lab Corporation, RKLB. Investigate as speculative gamble, Nebius Group NV.
And that wraps up another episode of the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for joining us today, everyone.
We'll catch you next time for more market commentary. Happy hunting!